Thanks for tuning in to Fed Watching. It's December 10th to 14th week, and we're going to have a new segment this time where I give you a couple of my favorite articles from the week in different categories. So if you want a little bit of further weekend reading, it gives you something to go back to. Let's go right into the market recap. It's Monday, December 10th, and just looking at the numbers, you wouldn't know it, but it's a pretty wild day. Market started down about 2% and then came all the way back to end positive. Otherwise, not a whole lot in it. Big news of the day was a guy in British Parliament went up and grabbed their ceremonial mace, and apparently that's a big deal because that's where their power comes from. So check it out and enjoy.
Debate to be resumed what day? Order, put it back. No.
Yeah, that's it. It's Tuesday, and another flat day for the markets. That was anything but boring. Today was the opposite of yesterday. Started way up, almost 2%, and then just gave it all back and then bounced around for the rest of the session. So not much of a move, not a lot of news. Trump did come out and said he thought Jay Powell was a good man and really hopes he doesn't raise rates next week. So at least we got that going for us. See you tomorrow. It's Wednesday, and market's up. Nice day. Not a lot of news. I mean, trade talks are what were driving the cycle, dominating the headlines, but we didn't really get any movement or any news there. So just a small little bounce. Nice little day for everybody in midweek. It's Thursday, and another day where markets were pretty much flat. A little bit mixed. Some things up, some things down. Only real driver in the news cycle was trade talks, but again, we didn't get anything definitive. So just kind of wait and see how things shake out for the rest of the year. It's Friday, and markets ended the week with a bit of a downer, 2% down, pretty much across the way. And again, not much news. Economic numbers that came out today were actually all pretty good. So a little bit of a down day to end the week, but nothing substantial. So the market had some ups and some downs this week, but really was the last day that ended up moving things and put us into slightly negative territory for the week, and then slightly negative territory for the year in a lot of cases. Both the S&P 500 and the Dow. The Russell's down pretty substantially for the year already, and so are international stocks, both the big ones and emerging markets. Wasn't a whole lot of news. Trade war was something that was talked about, or trade deals, depending on what the news was like. Almost every single day, we didn't get a whole lot that was coming from anything else. Got some weird stuff. Johnson & Johnson baby powder with some asbestos in it or something like that. But not a lot of earnings coming out that were driving it one way or the other. Not a lot of other types of news that were moving it. It was just a normal week where markets were moving 1 or 2% either way during a given day, and we got a couple more down percentages than up percentages this week. Moving over to the economy, not a whole lot of news. We're really waiting on next week when we're going to have an FOMC statement, maybe a rate hike, maybe not. Job openings were up and still really high. Producer price index came in a little higher than estimated. Core CPI, so consumer inflation, was right in line with kind of that 2%. Weekly jobless claims were at what's basically a record low. Retail sales were up, and that was a little bit better than projected. So again, nothing bad, and a lot of good things on the economic front. Stocks are going to be holding their breath a little bit to see what Jay Powell says the FOMC is going to do. That's going to come on Wednesday of next week, and the odds have definitely been moving more and more likely that they'll do nothing. In either case, if they raise rates and they say this means we're not, or we're much less likely to raise rates going forward, that could be a similar thing to, hey, we're not raising rates now, but we are going to raise them in a couple of months. The market might not care the distinction between the two, so we'll need to know both what they're doing and the messaging around it to understand how that's going to affect things. Welcome to the new segment where I give you my favorite reads from the week, and I'll have the links in the description of the YouTube channel and also in the podcast description. So you'll be able to find the full long form of all of these posts or articles if you want to read them yourself. So the first one is called In Defense of Finance. It's on the Put a Number on It blog, Jacob Falkovich. And he covers, I think, really useful, the fundamental usefulness of the finance industry, which I think a lot of people that know finance, they know investing, they know economics, can't actually put their finger on what does the finance industry do. And he gives some really good examples of what does the finance industry do. He talks a little bit about the risks of moving around debt. He talks a little bit about how regulations work and don't work. He talks some of his thoughts on capital requirements, and he's an industry insider, so interesting to see or hear his insight on that. And then his thoughts on how the government and finance are intertwined, and whether that's something that is always how it's going to be, that just happens to be the setup that we have. Very interesting read. Next one, Bitcoin is not a bubble, on EconLib by Scott Sumner. It's one of my favorite economists. And he expands on some of the points that I touched on last week. So people who called Bitcoin a bubble at $30 or $300 a coin, they're clearly wrong. He outlines a nice way to think about bubbles, and the way that you define the word bubble is going to define what you think of them. So good to hear his framework, nice to read, and I think helpful to people that are looking at it and trying to figure out what to make of Bitcoin and kind of future similar things that we can't identify now, but we know they'll be here. Then on the personal finance side, good news and bad news about saving for college on the Wealth of Common Sense blog by Ben Carlson. He covers the difficulties of planning for college with young kids in 2018 and gives some of his personal strategy, which is really useful. I do think there is actually a chance there's an end in sight, so I disagree with this part of what he wrote about. I'll also put a link to Lambda School. They're doing a really boot camp isn't the right way to describe it. It's longer than that, but a coding school where they're just putting all sorts of their students, some ridiculously high percentage of them, into really high-paying jobs. They're training people with what's normally a 4-year computer science degree in 6 months. And I think they could disrupt entire swaths of higher education with their model. And the big kicker to their model is they don't get paid until their students get a high-paying job, and then they get paid a percentage of their income back up to a certain amount. So they've really got their incentives aligned. They've got a bunch of skin in the game. If they don't teach these kids don't get a good job. They're not getting paid back. So I think that is really just another question mark for when you're saving for kids' college. Will they even go to a 4-year university like most of us think of? Makes it even harder to plan for, makes it even harder to answer the question, but at least it gives us something in sight. That's it for this episode of Fed Watching. Thanks for tuning in.